Hi, I'm David, the founder of Property Edge, and today we're going to go through a deep dive on the Compare Mortgages Evaluator tool. This tool helps you make apples-to-apples comparisons between two mortgage offers. You might be buying a property, refinancing a mortgage, or at renewal choosing between the renewal offer from your existing lender and an offer elsewhere. I am going to talk a fair bit about mortgage product details in this demo because the devil's in the details. Most people don't know about the details, and after this demo, you won't need to know them either. But I want you to understand why the tool asks for mortgage information that you might be unfamiliar with. And I want you to feel confident that the Compare Mortgages tool is looking at those details on your behalf and taking them into account when providing its recommendations. Now, for the purposes of this demo, let's say that Jessica is buying an apartment in downtown Calgary. She's a mid-level manager at a bank, and she's in a serious relationship. Let's get started. Selecting a mortgage is about more than just numbers. We need to consider some risks and make sure that Jessica is choosing the right product for her personal situation. So in this section, we're going to try to understand her situation and risk profile. We want to know if Jessica typically receives big bonuses or variable pay at work, because often people like to use these bonuses to pay down their mortgage. So this will be relevant to evaluating prepayment fees or penalties. Jessica's doing well, and her bonus is typically more than 10% of her salary. She is a first-time buyer, and she has less than a 20% down payment. There are levers you can use to lower regular payments that result in a higher total cost of borrowing over the life of the mortgage. These include paying an upfront fee or stretching your mortgage out to 30 or 35 years. Sometimes people are willing to pay more in the long run to have more cash in their pocket today. In this case, Jessica doesn't want to pay extra borrowing costs to reduce her regular mortgage payments. Jessica's young, she's a bit of a foodie, and she likes to travel, so she wants predictable housing costs so she can have more predictable disposable income to enjoy herself. She's not comfortable with fluctuations in her monthly payments. When asked, she thinks she's going to stay in this place for a while, so she's unlikely to move. Now, a wealth manager completing this with Jessica might challenge her. What if she gets a promotion at work to a role based in Toronto at the bank? What if she gets engaged? Will she want to get a bigger place with her partner? But right now, we're not going to go down that tangent. Well, next is payroll cycle. And for her, it's bi-weekly or every 2 weeks. Now we shift our focus from the borrower to the lender. Jessica is pre-approved with 2 lenders for a $500,000 mortgage over a 5-year term. A fixed rate at TD, her primary bank, and a variable rate through a mortgage broker dealing with Scotiabank. I'll walk through the inputs for TD Bank in the demo. I have a saved version that includes Scotiabank, so you don't have to watch me key in similar information twice, and we can just jump to the calculated results. Starting with TD Bank. Typically, people get a closed mortgage. An open mortgage can be repaid at any time with no fee or penalty. But with a closed mortgage, you have a higher level of commitment. If you repay a closed mortgage before the end of the term, they charge you a fee or penalty. Since the bank puts the same amount of effort into an open or closed mortgage, they charge a higher mortgage rate on open mortgages to try to recover their costs. In summary, an open mortgage is more flexible, and you pay for the flexibility with a higher rate. A closed mortgage, you're committed for the contract term. You get a better rate, and they'll charge you if you repay it earlier than agreed. 25 years is the typical amortization. Amortization is the lifespan of the mortgage, the amount of time that we expect it will take to reduce the balance of the loan to zero. On to rates. In this scenario, TD is offering a 5% fixed rate over the 5 years. And will input 20% for the allowable prepayment. Now TD's standard is 15, but to keep this demo fast and simple, we're going to assume both TD and Scotia offered 20%. The next question is more difficult. Is Jessica getting a collateral or conventional mortgage on the title or deed? This isn't so much about the loan, it's about how the lawyer registers the loan charge with provincial land titles. Lenders often don't talk about this up front, but it makes a big difference. A collateral mortgage is reusable or readvanceable. For example, if Jessica gets a mortgage for $500,000 using a collateral charge, and she pays it down to $300,000, she could ask her lender to bump it back up to $500,000 and reloan her the $200,000 difference. A collateral mortgage never expires though, and is never transferable. So if you want to move your mortgage, you need to pay a lawyer to remove or discharge it, and then pay a lawyer to set up a new charge or mortgage for the new lender. Because it's a little more difficult to leave a lender when it's a collateral charge, sometimes they don't offer you as good a deal when your loan comes due for renewal. Now, a conventional mortgage expires when the loan balance falls to zero, and it's transferable. If Jessica has a $500,000 mortgage with a conventional charge and keeps making regular payments until the loan is paid off, the title on her home will be clear. Likewise, if at renewal she pays off the remaining mortgage balance in one lump sum, the lien on her property is gone. She shouldn't need to pay any legal fees. Now, most people these days don't live in their home for 25 years, so if you move after 5 years, a conventional charge will fall off, but you will need to pay a lawyer extra to remove a collateral mortgage. There are pros and cons to each choice, but if you choose a collateral mortgage, you should probably budget about $1,000 at the tail end to remove the lien from your property. Back to Jessica. Jessica's going to choose a collateral mortgage. I want to revisit rate types because we're not going to walk through the Scotiabank offer in full. So, TD offered a fixed rate, but you should know there are two types of variable rates. There's a variable rate and an adjustable rate. People often call both of them variable rates because they both have interest rates that fluctuate in parallel with prime rates. But each product behaves very differently. With a variable rate mortgage, if interest rates go up, your monthly payment stays unchanged, but the interest costs go up, so the amount of money left over to reduce the balance on your loan gets squeezed. A higher rate reduces the pace at which you pay off the mortgage. If you fall far behind schedule paying down your mortgage because rates have been unusually high, then at renewal, your monthly payments could get increased significantly to help you get back on schedule. That's happening to quite a few people today in Canada because rates were so high over the last 2 to 3 years. On the flip side, if rates are unusually low, like they were during the COVID pandemic, then you pay back your mortgage faster than planned, even though your monthly payment is unchanged. Adjustable rate mortgages have the opposite effect. The payments can change, and the pace of the mortgage repayment is unchanged. If rates go up, your monthly payment goes up. If rates go up a lot, it can be difficult for some households to keep up. From the end of the pandemic to the peak in 2023, rates rose from around 2% to 7%. That's more than a 3 times increase in interest costs. So, with an adjustable rate, the regular payments on your mortgage may change from month to month as interest rates change. but you will be reducing your mortgage balance at the same pace, so you'll stay on schedule. Let's jump forward. Cashback. Here's an example of TD Bank's cashback offers. It's a complicated grid. For our scenario, Jessica is getting $1,000 cash back. Let me illustrate the challenge with cashback. Let's look at two offers. Offer A is a 5% mortgage rate for 5 years, and offer B is a 5.1% mortgage rate for 5 years and $1,000 cash back. 0.1%. It doesn't sound like much to pay in exchange for $1,000. How will you know which is the better deal? Frankly, you can't. It's not enough information. You need to know the balance of the mortgage, because $1,000 cash back on $100,000 is a much better deal than $1,000 cash back on $1 million mortgage. I've run the numbers for an amount in the middle. So 0.1% of $500,000 is $500. If the mortgage is for 5 years, then a higher mortgage rate costs nearly $2,500. So with offer B, the borrower is paying almost $2,500 over 5 years in exchange for $1,000 upfront. This is the magic of the Compare Mortgages tool. It turns rates, cashback, loan fees, and other fees into a single number, the total cost of borrowing. It's in dollars and allows an apples to apples, dollars to dollars cost comparison for the two offers. Okay, now I'm going to go back to the main screen. If you recall, I saved a version with the Scotiabank offer built in. Financially, the TD offer is better, even though both offers have a 5% rate over 5 years. So what's happening? TD is a fixed rate, and fixed rates are compound semi-annually. Scotiabank is a variable rate, and variable rates are compound monthly. So the effective annual rate for the fixed rate is 5.06. For the variable rate, it's 5.12. Again, these are decimal points. How much do they matter? Well, it's a $1,200 difference. That's a couple of flights somewhere sunny, some new chairs in the kitchen, or it covers the legal costs for you to switch to a new lender. I kept the other cash inflows and outflows the same, so we could focus our attention on this little known fact about Canadian mortgage rates. But typically the other costs vary significantly between lenders. Your choice of lender or mortgage broker can influence cashback offers, legal costs, appraisal fees, and other fees. Let's look at other considerations. Both lenders offered the same prepayment allowance, and Jessica has pretty good bonuses. She might want to use one of those large bonuses to pay her mortgage down early. So, if one of those lenders had offered a more generous prepayment allowance, that would be a consideration for her when selecting who to go with. About half of Canadians break or renegotiate their mortgage before the end of the term. Looking at a fixed versus variable rate, we're going to explore the fees or penalties if Jessica were to break her mortgage 1 year into her 5-year term. If rates stay the same or rise, and Jessica breaks her mortgage, either one of them, she will need to pay 3 months interest, which is around $6,200. If rates fall, because TD is a fixed rate mortgage, there's an interest rate differential fee. The tool has presented some scenarios to help Jessica understand the potential magnitude of these costs. She could be on the hook for somewhere between $20,000 and $40,000 if rates drop 1 or 2%. So, TD Bank's offer has the lowest borrowing cost unless Jessica breaks the mortgage and rates drop a lot. There's potentially more complexity here because there are three different ways lenders calculate interest rate differential. For the purposes of helping Jessica with the decision, we have used the simpler of the three. Payment frequency. Ideally, Jessica will want to match up her regular mortgage payments to her payroll cycle. That's because making more frequent payments reduces your borrowing costs. Finally, we have some commentary on where rates stand relative to long-term averages. And this is important to consider when you have a 5-year term. Variable rates today are lower than the average, so rates are likely to rise in the future. Likewise, there's information about where fixed rates stand against the historical average and where they're likely to go. That wraps up our demo today. You now understand how complex mortgage pricing and features are, and how the tool simplifies mortgage selection decisions with apples-to-apples cost of borrowing comparisons. You also have a better appreciation of how choosing a mortgage should take more than the advertised rate into account. As you've seen, lenders often make products more complex so that it's difficult to make these apples-to-apples comparisons. By making the cost of borrowing difficult to compare, it reduces the pressure for lenders to compete on price. This is why our Compare Mortgages tool is so essential. It helps people like Jessica to cut through all the marketing and product complexity and objectively compare two offers. In the future, we will add a column that compares the two lenders to the typical competitive offer available on the market today, so the user can tell if one or both of the offers is better or worse than what most other people are getting. That's it for today. See you again soon.